Hey, what's up, stock compounders? Brad here. So this is my weekly Q&A. Now, I don't have enough followers yet to generate all of the questions that I use for these Q&As from you guys. So there's a Facebook group, Value Investors. It's open to the public. There's over 100,000 members. And each week I pull a handful of questions from there and I answer those in this video. But if you have a specific question that you'd like me to dive into, either leave it in the comments below or go to my community tab and leave it there. I'm trying to kind of push people towards that community tab. I've been creating polls on there to try to generate some engagement with you guys and just try to get a better sense for where your head is at around investing and money. So anyway, let's dive into the Q&A. The first question, what is the biggest mistake professional investors make? So I'm not a professional investor, so I can't kind of pull from my experience and share my biggest mistake with you guys. But something I've seen come up repeatedly, professional investors talking about their mistakes, is this idea of trimming the flowers to water the weeds. Okay, essentially what that means is once one of their positions has gone up a lot, they sell some, right? They kind of rebalance their portfolio by selling this position that has gone up a lot and moving those assets into companies in their portfolio that are still kind of trading at a discount, cheap companies that are in their portfolio. And the danger here is that these companies that have had quite a run up in your portfolio, those may be the long-term compounders. Those may be the companies that you actually want to put even more money into rather than trimming that position. Because if you're trimming a position from a long-term compounder, that's really going to have a negative effect on your portfolio in the long term, especially if you're, putting that money into companies that are trading at a discount. Maybe they're trading at a discount for a reason. So this is one of the biggest mistakes professional investors make, is shaving their best positions because they've gone up so much. And it's hard. It's hard to know when to sell. Right? And I'm going to make a video about this. A good friend emailed me and asked, I get how to buy. I get that you're looking for a great business at a good price. But how do you know when to sell? I mean, it's a challenge that professional investors have a really hard time figuring out as well. Guy Spear, not too long ago, was talking about a mistake he made with Crystal. Crystal is a rating agency in India. And how he found that, it's kind of interesting. He'd known about Moody's for years. Moody's, incredible long-term compounder in the US. And he set out to find companies that were similar to Moody's in different markets throughout the world. Assuming, a company like that might have a similar kind of long-term competitive advantage as Moody's did, and he ended up finding Crystal. And he bought Crystal. I think he sold after like a 4 or 5x jump in the stock price. Had he simply held on to Crystal and identified it as a long-term compounder, it would be the largest holding in his portfolio right now. So, that was a big mistake. And it makes sense. You don't want to cut the flowers and water the weeds. The hard part is identifying what the flowers are versus what the weeds are. But anyway, let's move on to the next question. What books about investing do you recommend? So, most people talk about The Intelligent Investor. They talk about security analysis, both books by Benjamin Graham. There's the Warren Buffett letters to shareholders. A couple of the books that I really like that maybe don't get as much talk in the investing circles. You guys, a lot of you are familiar with Monish Pabrai. I'm a huge fan of the Dondo Investor. I like the book called The Most Important Thing by Howard Marks. I like a book called 100 Baggers by Chris Meyer. That's a study of stocks that returned 100 to 1 in the last something like 50 years. And what the commonalities were between those stocks that were 100 baggers. Fascinating study. And then, of course, the little book that beats the market by Joel Greenblatt. It's super easy read, and he kind of discusses how he arrived at the magic formula, which is a combination of stocks that are cheap and good as measured by earnings yield for cheap and return on invested capital for good. And it's just a fantastic book. Joel Greenblatt is a legend in the value investing community. He ran a fund for like 20 years and generated 40% annual returns, which is phenomenal, absolutely phenomenal. I think they had to close down the fund because it was just getting too big. They were making money too fast. And once you get to a certain point, it becomes a lot harder to make a 40% rate of return when you have, they say a fat wallet is the enemy of high returns. So, his best option at that point was just to return money to his investors and do his own thing. So that's a good problem to have, making too much money. Question 3, is it the time to be greedy or fearful? We're all familiar with Warren Buffett saying, be greedy when others are fearful, be fearful when others are greedy. Yeah, that's a great question, guys. Is it the time to be greedy or fearful? Personally, I think the markets are a bit frothy. I think there's, the markets, there's a higher sentiment in the markets than there are in the economy. The markets are kind of rosier levels than, unemployment, and just where people are at on a day-to-day basis. So, in my kind of perspective, I think it's the time to be more on the fearful side, more on the conservative side, more attention to risk, more attention to the possibility of losing money than attention on chasing returns. That's kind of where I'm at. Of course, in any market, there are always deals to be found. There are always stocks that are trading at a significant discount to, what the intrinsic value is, what the value of the business is. It's just a matter of, are those opportunities available in an area that you understand, in kind of within your circle of competence. So I'm leaning towards the fearful side at the moment. Particularly as the cases of what's been happening with the pandemic are starting to go up again as we lift restrictions on businesses and socializing and start to open up again. It seems like we're going to be contracting again quite soon out of necessity because of these rises in cases. So I don't think, I'm not in any hurry to deploy capital. I'm fine letting the cash kind of pile up a little bit here. I don't think we're in the clear in terms of the economy. So that's where I'm at. Number 4, what are your thoughts about Berkshire stock? I don't even know what it's at now. I think it's at around $175-ish per share for B shares. I think it's fair value for B shares are probably around 200. About 1.3 in terms of price to book, I think is probably around fair value. you know, what is that, a 12% discount if it's at 175 and the value is 200? A 12% discount doesn't excite me very much. Yeah, you know, I think it's probably fine if you feel like you need to deploy some money as an investor. It's certainly cheaper than what I'm seeing, you know, in terms of Apple stock, Amazon stock, even Facebook recently kind of did a little run up. If you need to deploy capital, I think it's probably a good bet compared to other businesses on my watch list. But that's the thing, you don't actually need to deploy capital. You know, there's no called strikes on Wall Street. You don't need to swing right now. So it's not a screaming buy for me. But like I said, it's not a terrible place to put money if you have money burning a hole in your pocket. Question 5, how long do recessions usually last? So we're technically in a recession. So this was, you know, kind of an interesting question. Looking back at the last 14 recessions, the average is 402 days. That's how long a recession lasts on average. Now, I don't know that the average is a very useful number. For me, it's more interesting to look at kind of the range. You know, what's the shortest recessions that we have and what are the longest? And, you know, where are most of them kind of falling in between there? So the shortest has been 181 days, which is basically 6 months, half a year. The longest was 3.5 years, and that was back in the Great Depression, 1929 to 1933. There were a lot, interestingly enough, that fell around like 240, 245 days. That was kind of interesting. There was a little bit of a cluster there. So what is that, like 8 months? You know, I don't know that any of that is really useful in terms of guiding your investment decisions. Just, you know, what we're going through now isn't like anything that we went through in the last 14 recessions. You know, the last 14 recessions don't cover the last kind of massive pandemic like what we're going through now. Shutdown in the economy because, you know, people need to keep their distance. None of the last 14 recessions have involved that kind of quality to the recession. So, you know, it's just kind of interesting. Average 402 days. You know, I don't think we're anywhere near coming out of the recession. So, again, I'm not in a hurry to deploy investment capital. Number 6, what is your favorite Warren Buffett quote? Okay, obviously there's a ton of fantastic Warren Buffett quotes. The one that really has been calling out to me recently, it's something I like to remind myself of often. The stock market is a device for transferring money from the impatient to the patient. Okay. You know, I think it might have been Joel Greenblatt, I think it was, who wrote, I think the latest book that he wrote was all about how the biggest edge we have as investors is patience. Okay. There's so many people who are in a hurry to get rich quick on Wall Street. You know, people who buy, sell, such short duration holding of stocks. And if you can adopt the mindset as an investor of, you know, I'm buying into this business because I believe in the business. I am a partial owner of this business. And I'm not in a hurry to make money. I see great future prospects for this business, and I'm just going to park my money here and let the business make money for me. Okay? That's really the mindset of investors who tend to do well investing in stocks, is Benjamin Graham preached this. One of the key things to value investing, successful value investing, is to look at stock shares not as pieces of paper, not as moving ticker symbols on a screen, but as partial ownerships in a business that you actually want to be an owner of. So, I think that's a fantastic kind of quote to really sink in that mindset of patience. I like another thing Warren Buffett says about how, you do very well as an investor if you had a punch card of 20 different stock purchases. So you only can buy 20 stocks in your life. Now, obviously, you'd think long and hard before you bought each one. And that's, again, that mindset of being an owner in a business. Question 7, does a stock price always eventually get back to its intrinsic value? And if so, how long does it usually take? So, I like this question. I like any question about intrinsic value. Intrinsic value, there's no, sticker on a stock that says, here's what the value is. Any two people who are coming up with an intrinsic value for a business are going to have different numbers. So there's not an intrinsic value that's correct for a company. So it really comes down to how skilled is the investor at coming up with the intrinsic value. And of course, even if you're the best in the world at valuing a specific company, like say Warren Buffett was coming up with the intrinsic value for Berkshire Hathaway, it's possible that the market, the stock market, may never price Berkshire Hathaway again at its intrinsic value. There's always a chance that something is going to happen with the business, where it's going to go south, where investor sentiment even is going to go south. So intrinsic value is a moving target. It doesn't move nearly as fast as stock prices, because you have all of the kind of investor emotion, fear and greed that drive the stock prices on top of what the financials of the business indicate that the company is worth, and the skill of the management, of course. So no, price doesn't always have to get back to its intrinsic value. And that's why it's important to buy at a margin of safety. It's important to buy at a significant discount to the intrinsic value. Because then, even if the price doesn't get all the way back to the intrinsic value, you can still make money. Okay? Say you buy at half price from intrinsic value, and it gets back up to 80 or 90%, in a fairly short period of time. You're still going to do quite well as an investor if you bought at a low enough price. And then finally, question 8, when should I invest in airlines? Everybody wants to invest in airlines. And I get the desire to invest in airlines. You see an industry that's been beat up, right? And you think, all right, the price is beat up. As investors, we want to buy when the price is significantly below value. So it stands to reason, maybe the price is beat up enough to the point where there's a significant margin of safety there. Personally, and I'm not alone, Warren Buffett sold out of airlines. I think there's a reason that the price has been beat up. I think intrinsic value in airlines has taken a hit because of what we're going through economically, because people are afraid to travel, particularly on airplanes. Who wants to be sitting shoulder to shoulder with a stranger in this time that we're in? Nobody. Some people will. I'm sure some people will still fly. But when you have most people who used to have no problem flying aren't interested in flying, when you have the majority of people in that situation, with how thin profit margins already were for airlines. Like if you're not filling the middle seats of those planes, it is very difficult for airlines to make money. And of course, it's a heavy, there's a lot of fixed costs in the airline business. Okay, so it's not like they can just scale down expenses if they're not making money, right? So high fixed costs and thin profit margins. That is a tough business to be in. So as an investor, I don't know why you'd even want to buy airlines. That's my position. I think it would be very difficult for the stock price of airlines to get low enough to the point where I would be interested in buying airlines. There's plenty of other things to look at other than airlines. So when should I invest in airlines? I'm not interested in investing in airlines. And I would strongly caution you to value these airlines conservatively. Come up with your own intrinsic value based on a conservative reopening of the economy, of people getting back on airplanes, at a slow rate. Build that in to your valuation for these airline businesses, and then insist on a significant margin of safety below that before you buy in. So, that's it, guys. That's 8 questions that I wanted to cover in this video. Again, if you have any questions, I'd love to answer them for you personally. Leave a comment. And I hope you guys had a great 4th of July, and I will see you in the next video. Take care.